In 2022, Netflix lost its FANG status after spooking investors with a 200,000 subscriber loss in the first quarter of 2022 as the pandemic eased up. This caused the net worth of Netflix to drop by $200 billion as the share price crashed. However, with Netflix's latest adjustments aimed to tackle account sharing paired with their introduction of a new ad support tier, will Netflix's stock bounce back due to its ad revenue potential and improving cash profile? Given the status quo, most tech companies have hampered down on operations due to global supply chain disruptions. Netflix, on the other hand, has an offensive strategy to increase subscribers and revenue despite the macroeconomic pressures. In November, the firm will launch its first ever ad-supported tier for $6.99 a month, where viewers are expected to receive 4 to 5 minutes of ads every hour that they watch. Surprisingly, Netflix's third quarter earnings were far above Wall Street's estimates after losing subscribers for 2 consecutive quarters straight. In addition, the latest report shows that Netflix has managed to acquire 2.4 million additional users, largely resetting its losses. As a result, Netflix's stock jumped 14% on Wednesday, October 19th, after the publication of its third quarter results report on Tuesday evening. Revenue at the streaming video behemoth increased 6% yearly from $7.93 billion, above analysts' estimates by $90 million. Its profits per share fell 3% to $3.10, yet is still largely beat by the consensus estimate of $2.13. More crucially, Netflix acquired 2.42 million paying customers sequentially, bringing its two-quarter subscriber losing skid to a stop. Do these good events imply that it's now safe to purchase Netflix's stock, which is still around 60% below its all-time high from last November? Netflix shocked investors in April when it reported its first sequential loss of subscribers in over a decade. It attributed the slowdown mostly to increased competition in the streaming industry, the effect of the Russo-Ukrainian conflict, and password sharing. It claimed it would clamp down on shared passwords and launch a lower-cost ad-supported tier to entice new users, but those steps also indicated that it was running out of ways to get new members. Netflix's paid members increased again in the third quarter, thanks to popular programs such as Stranger Things, Monster, The Jeffrey Dahmer Story, Extraordinary Attorney Woo, The Gray Man, and The Sandman. It forecasts its paid subscriber base to increase by 2% sequentially to 228 million in the fourth quarter. Netflix's stable membership growth is promising, but the revenue growth has slowed. It attributed the slowdown to the company's increased reliance on foreign markets, which yield lower revenue per subscriber than the saturated US-Canada market, as well as the effect of rising currency rates on overseas income. As a result, it anticipates fourth quarter sales to be up less than 1% year-on-year and down roughly 2% sequentially to $7.78 billion. However, in constant currency terms, this equates to a 9% year-over-year rise. The ad-supported tier costs $6.99 per month in the US, which is $1 cheaper than Disney's ad-supported Disney Plus and Hulu tiers. During the conference call, CEO and CPO Greg Peters anticipated that the lower-cost ad-supported tier would bring in a lot more people and become a major incremental income and profit stream in the long run. However, Netflix's fourth quarter revenue indicates that those tailwinds will not be fully realized by the end of the year. Netflix's operating margin of 19.3% in the third quarter was actually above its own expectation of 16%, but it fell sequentially year over year. It attributed the majority of its year-over-year drop to the strengthening of the US dollar, which is expected to continue as interest rates increase. Netflix also anticipates that the pressure in infrastructure expenditures associated with the addition of the ad-supported tier will drop its operating margin to only 4.2% in the fourth quarter. It also anticipates a 73% drop in profits per share year over year. However, they were unable to offer an accurate fourth quarter projection for its free cash flow, which varies greatly depending on new content development. However, Netflix aims to only earn around $1 billion in free cash flow for the whole year, implying that its free cash flow would likely turn negative again in the fourth quarter. Analysts predict that Netflix's sales will climb 7% this year, but its profitability will fall by 10%. They also anticipate $8 and $6% revenue and profitability growth next year, assuming that it continues to win new subscribers and expand its ad-supported tier. According to such projections, Netflix trades at 23 times the projected profits, which is a historic low, but hardly a steal when compared to other conventional media businesses. Disney, for example, trades at 19 times forward profits, and Paramount Global trades at an even lower forward price to earnings ratio of 9. At its present growth rates, we believe Netflix should trade more closely with other market competitors due to the saturation of the streaming market rather than with higher growing tech businesses. Netflix currently has the advantage of having reclaimed the title of largest streaming network by subscriber count, which it temporarily lost to Disney in the last quarter. It has changed its model in the past to reflect the reality on the ground, and with the ad-supported tier, Netflix signals strong prospects for future growth. Investors are taking favorably to this news as Netflix's stock is up 25% since the last month, but the overall share price is down by 57% since 2021. Although the price is still favorable, uncertainty in Netflix's future earnings as well as the aggressive competition in domestic markets is a huge variable in its profitability. Thus, we give Netflix an overall hold rating. Online retail platform Shopify has suffered an 85% drop in its share price since 2021, while revenue has largely stayed consistent. Check out this video on why Shopify's stock is largely undervalued and is at an attractive price point for double-digit gains. Thank you for watching, and please like and subscribe for more videos.